And good evening to you. I'm Dennis Hudson at orangequant.com. It is Thursday night, December 1st, 2011, and I'm doing an update of the PV indicator training video. It's a very short video here. I just thought I would renew that, kind of update it for you. And we post these snapshots of the PV indicator pretty much daily. And I just want you to know how to read them and how to use them. At some point we'll probably put out the actual algorithm underlying the PV indicator. But for now, you only really need the snapshot after the close of the day, and it tells you a lot about what's probably going to happen the next day on the S&P 500. Okay, I don't want to get into too much detail here because it's really very simple and straightforward. First, let's put some names on the indicators that you see. Alrighty, as you can see, we've named this lower one, this turquoise one, is called Warren, and the upper one we're calling green. Don't be too concerned yet about the blue and red indicators. Just be concerned about green and Warren. What those upper three are, the green, red, and blue. Green is a very short-term moving average of the indicator, and the red and blue are somewhat longer-term moving averages. Warren is a whole different algorithm from green. The whole idea of the PV indicator is that when green and Warren flex in the same direction, then you have a signal for either up or down. If they flex clockwise, as you see in this image right down here, they both flex clockwise, so they're in agreement. And clockwise rotation means that the next day you should see, sometime during the day, a price that is greater than the close of the signal day. So the next day after this candle would show a price that is greater than these aren't prices on the SPX. It's a value, but same thing. So you'd see some value greater than 1215.65 the next day. Now, if they both rotate anti-clockwise from their original direction, then that's a signal that you'll see something lower the next day than the close. Now, this has nothing to do, that's if they both agree. They always have to agree for it to be a valid signal. Now, this does not mean that you will have an up day or a down day. It only means that you will have a price that will be either greater than or less than the close of the signal day. In general, I have found it best to wait until the next day, the next morning, to place my trade, usually because I'll get a better price. Sometimes that means not getting in at all because it will open at a point that fulfills this forecast. So it makes it tough at that point to decide which way it's going to go. If you have other indicators that can help you, then fine. Now here's one that's really tough to read. You almost have to draw a line on it to read it, which is what I'm going to do here. Let me see where that is. Okay. If we extend this line here, you just barely, that was this first part of this to the left here is the signal from the day before, and you can see that Warren rotated to the right, in other words clockwise, and so did green. So they agreed. So sometimes you have to look closely. And again, if they disagree, you have no bet. You have no signal and no bet. Now, one more thing about green. If green goes up into this area here, above purple, at that point we've been saying you have to disregard the whole signal from the day, whatever it is. That may or may not be true because we instituted and installed purple, this upper purple line, before we had the Warren line. And now Warren controls bad bets just as well as purple did. So at this point I'm not making a big issue about purple. Alright, one other little tip here, and that's about worn, that lower turquoise line. And what happens is sometimes worn really rocks up and gets almost into the green and its cohorts, red and blue. It sort of invades. We call it worn invasion. And when that happens, in looking back over about the past year, 10 out of 13 times that produced a strong uptrend in the SPX. And here is what some of that looks like, this worn invasion. Notice right here, and I'm going to make kind of a fatter blue line. See these gray lines going across? Those mark worn invasions. So I won't have to make a fat blue line. Just follow that little gray line there, and you see right there, right after it, within a day after, it started this powerful uptrend like that. The next one, the same thing. Actually, it took, well, 1 or 2 days, and it followed a powerful uptrend. It launched a powerful uptrend. Same thing here. 1 day later, and the SPX went into this long, powerful uptrend. Finally, we get over to these last two gray lines, and we get, it took about 1 extra day, 1 or 2 days, and made a little uptrend. Here went 1 day and started an uptrend. So you can see the power of it. Now I'm going to show you the 3 times when it went wrong. As you can see, these pink lines, here's a strong worn invasion. Just follow the pink line up, and you can see, I'm going to slide that up a little bit, that first pink line. You can see that was way back here. You would have entered long, but the downside lasted for a week. Well, you could say 2 weeks on that. So that was a loser. Here's another worn invasion that's marked, and you can see that took about a week before that matured into something. So you were losing for a week. And this last one was really disastrous, this last pink line over here, because instead of a strong uptrend, it resulted in this massive long downtrend, and the recovery, the bounce from it, wasn't all that great either. So, 10 out of 13 times. Oh, you want to see the other, the rest of the times when it went right? I'll show them to you. Here they are. They're all marked by gray lines. Here, let's see. This would have been right next to that, starting that uptrend right there. This one, you can see another uptrend going on like that, and each one of them is showing, each one of those gray lines, vertical lines, is showing you a good strong uptrend immediately after worn invasion. So I hope this was helpful to you, and that you'll come back and check out the snapshots. We do this as a public service. It's free. We're trying to increase the number of bettable days, because right now the number of bettable days versus no bet days are about equal, and you might want to trade more often. However, it's important to remember that this is about conservation of capital. So if you're into trading just for the sake of trading, this probably isn't the indicator for you. But if you're into capital conservation and saving your money for those times when you can make a really good trade, then PV indicator is exactly what you want. Now, we do maintain a running scoreboard there at orangequant.com on the PV indicator, and this is what it looks like. And actually, those numbers for the right, the right calls that we had, are running somewhat behind the back test. And the reason is mainly that our no bets are starting. We had a string of no bets, and you can see we've only been tracking this for about, well, I don't know, 3 weeks or so, but a string of no bets. And what that means is we get fewer rights. But as we get fewer no bets and more bettable days, our rights will increase faster than our wrongs. All right, so you might want to, you can pause the video and study that if you want to. Now here is the back test. Okay, and you can pause the video and read that over if you like. The back test shows over roughly the past year, 89.7% PV success rate, and the total wrong is about 10%. So it's about 90 to 10. Okay. If you go back to the previous chart, you can see what I believe is the temporary difference between the back test and the actual test.